Welcome everyone. I hope you are doing good. Today's our second lecture about key levels, and today we're going to learn supply and demand levels. Before starting the main part of today's lecture, let's quickly talk about S&P 500. So for today's continued its downtrend, it was consolidating on this zone, like here, and after that starts defalling. So yeah, you can see that clearly, and notable large cap tech stocks like Nvidia contributed to the decline with ongoing concerns about economic growth and company performance weighing our own investor segment. And so on the positive side, like Tesla and, for example, Model S saw gains. So it can still protect situation on this zone, as you can see, but it's not telling us that, this downtrend will not be continued. It's not that strong to change the investor sentiment because right now the investor sentiment is negative. And also, market participants are closely watching treasury yields, which dropped slightly, reflecting changing expectations around interest rates. And now investors are awaiting key labor market data later this week, which could impact future market direction. All right, that's it. So currently is continuing to fall. The downtrend sentiment, negative sentiment is strong, but we're getting a tiny, tiny signals of the reversal. But they are not that strong. To be honest with you, personally, I will ignore them right now. All right, there we go. So now let's talk about supply and demand. So everything is really similar to support and resistance, but still there are some differences. Like, so demand zone is also another key level on the chart, special zone on the chart, when where buying orders are significantly more than selling orders. And because of that, the price is rising. Supply zone is the opposite thing. We have a lot of selling orders than buying orders, and because of that, the price is falling. So whenever the price is touching demand zone, it is rising. It's touching supply zone, it is falling. There we go. And now I want to show you examples of supply and demand so you can see what are the differences between the support, the resistance, and supply and demand. But right now, do not worry. If you can't understand how I identified these, how I draw this a little bit later, you will learn all this stuff. Just right now, remember that supply zone, it look like this, and it's always located above the current market price. So current market price is very last price that you can see on your charts. Okay, the very last one. In our situation, it is this one, and it's always above supply. It's always above the current market price. There we go. That's how it looks like. And this is example of the demand. That's how it looks like. And it's always below the current market price. So here the current market price is this, and as you can see, this demand is below. But you can see that kind of the difference between supply and supply, the resistance, and demand and support, they exist because they don't look like a similar. Okay, so why, how, and so on, like we will find out today. Just let's quickly conclude and move on. So, like supply and demand, they are created and confirmed and protected by the BFI. So BFI stands for Big Financial Institutions, just in other words, market makers. So if in case of support and resistance, they are created by market makers, but confirmed by the retailers. Here, creation and confirmation is happening by like BFI. Yeah. In most of cases, on supply and demand zones, we have a lot of unfilled orders waiting to get filled. So a lot of traders, they are putting limited orders on that zones and waiting until the price will hit them and they will execute their limit orders. And also it helps to track smart money action. So I'm pretty sure you heard about this technique of trading, smart money action, smart money following. It is absolutely same thing as the price action analysis, just modern name for marketing, for YouTube videos and so on. But it's 100% is equal to price action analysis. As price action analysis, main concepts are the market structure, key levels such as supply and demand. So if you like to track smart money or use a price action analysis, supply and demand will be your number two most important tool. Number one will be the market structure. Number two will be the supply and demand. There we go. Now let's learn how we can identify the supply and demand. And before identification, you also, as in case of support and resistance here as well, you need to learn the patterns of supply and demand. And here, as in case of support and resistance, as here as well, we have reversal and continuation patterns. But also each pattern is divided into two types, like bullish reversal and bearish reversal, bullish continuation and bearish continuation, okay? That was Delph, and we're starting with reversal patterns. So we have two reversal patterns. The name of the first one, it's drop, base, rally. That's how it looked like. So drop, base, and it's a bullish reversal pattern. It's showing us how the price is doing reversal from falling to rising. And you may ask me, all right, I understand what is the drop, what is the rally. Rally is another word of the rise. Kind of, you can say drop base rise, but no one's saying that. Like everyone says drop base rally. But understand that rally is equal to rising. But what is the base? So look, base, it is the zone of the candlesticks or just one candlestick that are causing a rally after the drop or causing a reversal movement after the main movement. So here the main movement was a drop. After that, it's causing like there's a base that stops this falling and causing this rally. All right. So base it is kind of the control point that makes the trend to start another movement to start. So drop base rally, it is the pattern of bullish reversal. And we have the second reversal pattern, it is the rally based drop. So it's a bearish reversal. So it looked like this: rally in the price, base, and drop. And again, base here, it is the zone of the candlesticks or just one candlestick like here that is causing a reversal or causing another movement. So here the price is rising, base formation, and falling. So that was about reversal patterns. And also we have continuation patterns, and for continuation also we have two variants, bullish and bearish. So here are the bearish version. So it's a drop, base, drop. So there's the drop after the base formation. Instead of the rally, we have another drop. So it's a bearish continuation. It's continuing the downtrend, okay? Then the rally base rally. So there is the rally base formation, and instead of drop, we have another rally which continues the prevailing uptrend. There we go. And now by knowing all possible patterns, the reversal, continuation, and bullish and bearish versions of each one, with help of three-step recognition guide, you can easily identify your supply and demand. So let's find out how. So step number one, identify the CMP. CMP stands for current market price. And as I told you before today, it is the very last price that you can see on the chart. So in our example, that is this. So CMP. Step number two, find the last group of the ERCs by looking left from CMP. So first of all, we need to understand what are the ERCs. So ERC stands for extended range candlesticks. One more time, E, extended R range C candlesticks. So this is the name of the long candlesticks with massive body. And you need to go look left from your current market price to find not just one, not just two, a group, entire group of that kind of the candlesticks, that kind of a massive long candlesticks, or in other words, group of ERC. So I'm going to take a look at the left part from my current market price and understand where is the last group. And I'm identifying two possible last groups. So this one here and this one here. As I can see, my price is close to the base of this ERC. That's why I will choose this one, not this, okay? So this is the group of the ERC candlesticks. You can see that most of them are long and massive. Yes, still there are some opposite colors, but in most of cases, these are bearish ERC candlesticks. That is step number two. You need to identify the group of ERC candlesticks. Step number three, find origin of the movement. So what is the origin? Origin is equal to base. Remember, we learned the patterns. Drop base drop, rally base rally, drop base rally, or rally base drop. So same as here. You identify the pattern, and the base is equal to your origin. As you can see here, we have kind of drop, base, drop. There we go. drop, base, drop. And this base here is becoming as the origin. And the zone of the origin is exactly your supply or demand. Okay, there we go. That's how you're identifying. It's not like a support and resistance. It's really different because the formation is absolutely different. There we go. So here, the origin will be your supply. Same logic is for demand. So you're identifying your current market price going left, but now you're finding group of bullish ERC instead of bearish. If you're finding bearish ERC, then your origin will show you supply. If you're finding bullish ERC, your origin will show you demand. But the steps are absolutely same. All right. So now you know how to identify them, but I want to tell you one thing, like when you open the charts and you're starting to identify a lot of supply and demand levels, you will realize that there are millions of them on the charts. They occur even kind of commonly than support and resistance. But we want to trade only with high quality supply and demand zones, only with high quality, because only high quality can cause the reversals with higher chances. But how to identify that these supply or these demand zones are high quality? So for that, we have a special scoring system. So what is that system? So let me explain you. Like, there are four most important criteria about supply and demand, which are the base, price movement strength, and FVG, fresh zones, and triple R. What is FVG and triple R? A little bit later, I will explain. You do not worry if you don't understand. Four most important criteria. And scoring system, it's what doing. It is scoring each criteria, then summing each one and getting total score. If total score is high, it means that it's a good zone. You can trade with that. If total score is low, it means that it's a bad zone and it's better to avoid such a key level. Boom, that's it. So now let's delve into each criteria, understand how you can score that and how this stuff is working. So the first one, it is the base. And here I have a kind of criteria for high quality base. So in the base, we need to have less than 6 candlesticks. Base candlestick body needs to be less than or equal to 50 to 70% of the full length of the candlestick. And price has to leave the base with at least 2 ERC candlesticks. So you already know what is ERC, 2 extended range candlesticks, 2 massive big body candlesticks need to leave the base zone. And here I have an example of high quality base. So here we have drop base rally type of pattern. And this is our base zone. We're marking that and let's start kind of scoring. So first criteria, less than 6 candlesticks. We have 1, 2. We're done with this criteria. Candlestick body less than or equal to from 50 to 70% of the full length. Here we got a 50, here we got 70. Great. Second and third and last criteria says that price has to leave the base with at least 2 ERC candlesticks. This is the base here. 1, 2, 3. We're required to have at least 2. Here we have 3. That's good. We're done with all 3 criteria, and we can easily say that this base zone is high quality. But now I will show you a bad example, like bad low quality base zone. So here the same pattern, drop base rally. This is our base zone. So we're starting first criteria, less than 6 candlesticks. Here we have 1, 2, 3, 4, 5, 6, 7 candlesticks. We're not done with the first criteria. Second criteria, body less than or equal from 50 to 70%. You can see some of them are less than 50, some of them are more than 70. So some of them keep this criteria, some of them are not keeping them. But we want to see that all candlesticks in the base zone keeps this rule. So we are not done with the second rule as well. And third rule says that price has to leave the base with at least 2 ERC candlesticks. Here we have 3. Yeah, we are done with this criteria. But with the first 2, we're not done. It means that it's a bad base zone, low quality. So now you understand what is good and what is bad. But how you can score it? Quite simple. Like, if on your base zone you have from 1 to 2 candlesticks, and the body of that candlestick it is from 50 to 70% of the full length, it means that it's a very strong. You need to give 2 scores. If there are from 2 to 3 candlesticks and the body is from 40 to 80% of the full length, you're giving a 1 score because it's strong base, but not that strong as in this situation, but still strong. And if you have from 4 to 6 candlesticks and more, and the body is from 30 to 90% of the full length, then and lower and higher from that range, then you're getting a 0 score because it's a really weak base zone. Let's move on. Now let's understand what are the ERC movements and FOG. So ERC, you already understand extended range candlesticks. You need to understand how many they are, how powerful they are. But what is FOG? So look, FOG stands for fair value gap. And in technical analysis, it is absolutely different thing. But here, it is another thing. So let me explain you what is FOG here. So FOG, it is the sequence of, it is the distance between the first candlestick shadow and third candlestick shadow in 30 candlestick sequence. So for example, like this is 1, 2, and 3. So we take these 3 candlesticks together and they are making for us a sequence. So we take the first candlestick shadow and the third candlestick shadow, and distance between them will be the FOG. Okay, there we go. Another example for you. Let's say we don't have a rally, we have a falling like here, like 1, 2, and 3. We take the 3 candlesticks, they are making for us a sequence. So we take the first candlestick shadow and the third candlestick shadow, and the distance between them will be the FOG. So in case of rally, you take first candlestick upper shadow, third candlestick lower shadow. In case of drop, you take first candlestick lower shadow and third candlestick upper shadow. And the distance between them is FOG. So if you have a big or middle FOG, it means that is good. Why? Because big FOG showing us aggressive movement showing us that the price will go far, which is really good. That's what we want to have from this Q level to cause aggressive movements. Because for the second time, if it will touch, we can say